Today, we'll be looking at the factors that we need to see for the market to actually bounce. So let's start with this chart. As we know, the S&P 500 just logged a second consecutive 1% decline for the first time since March 9th and 10th. As we know, that came very close to marking a key low for 2023 after the S&P pulled back about 9% from February to March. That pretty much lines up with the 10% pullback we have right now. But we need to go further back to get an idea of what these two straight 1% declines mean, because, again, only two instances so far in 2023. In 2022, there were 13 different iterations of them, and actually only one time did that extend further when we had 4 consecutive declines from June 8th to June 13th. What we have highlighted here are just the ensuing days after those streaks ended. And as we can tell, basically every single time there was a rally attempt. As we know, this did nothing to the long-term trend all the way in through October, but still interesting to see that after 1% declines came what? 1% gains, 1% gains, and a lot of that all year long. And so it makes the case that we could be ready to see another rip your face off rally at some point soon. So looking at the drawdowns, again, down about 10% from the high here, which is the biggest drawdown we've had since last August to October. We know that. And more than what we've seen so far as well from February to March and also December. But I would say not that much deeper of a drawdown than those two as well. Definitely longer, but that much more on the downside. Now, we can break this up into smaller segments as well, just looking at what's happened over the last year here of drawdowns of at least 5% or more. And again, we're just at about 6%, which really isn't too different than all the other ones we saw before bid came back in. Now, we know almost every time these were faded. Most recently, 5% rally, 4% rally. And so the case could be made that the next one could also fail, but it could also be the beginning stages of something else going forward. We'll look at that as well. So we just always want to pay attention to any short-term change of character for the potential next opportunity to arise. And so looking at this table that we update all the time, now have 5 1% declines for the month of October, which is the most since we had 5 both in February and March of this year. Now, the difference so far is that we're missing equal amount of 1% gains, right? As we know, going back to 2022, even during the roaring bear market, there were just about an equal amount of 1% advances as there were declines, which gave us that two-way volatility and opportunities on both sides of the tape, even though it was obviously very fierce back and forth price action. But recently that's changed because over the last 3 months, 8 1% declines, only 4 1% gains, and that's really been representative of why the market has been really going lower pretty consistently since the July high there. And so in terms of patterns, because of that, we've had pretty intense extension of the breakdown finally from the big bearish pattern here. And we can see that if nothing changes, you can very easily hit that 4,050 target. Now, also with yesterday's action, we broke through a smaller, very clear other bearish formation here that has a downside target of 39.75. So if a bid comes back in relatively soon, though, this may turn into a bear trap and go higher from there. That's why it's important to see that happen if it does over the near term. Now, sticking with the short-term view here, we talked about this before. S&P just needs to take advantage of a short-term oversold condition much better than it has. We talked about it right here when we first got that oversold condition, how that may not actually lead to something more substantial just yet because of what happened in the most recent past. Back in August and September, it extended for over a week before we actually saw buy interest lead to something more substantial. And so now we're just a few days into this. And, bottom line is that we just need to see a better effort relatively soon, because without taking advantage of that, we can't even talk about short-term bullish formations being formed. Speaking of which, that is obviously what we want to see next, where we're going back to when this previously happened back in October. We went through the different steps that needed to occur, right? Number 1, hold that support. Number 2, see upside follow through. Number 3, have a lower high. for, form the bullish pattern, have the breakout, which we did, but we did not get the upside target. That's absolutely necessary to have a turn, especially for a very short-term basis, because again, you don't get an upside target acquired from a short-term basis. There's no way you can talk about something more substantial. And so, as we can see here, if we do have something developed again now, this is how it could develop, right? Hold support, upside follow through. We have a higher low from here, have the breakout target hit. Then repeat that process, meaning that you come down here and make another pattern or form a bigger one, right, from here and up. And so it's going to take some time. We're not into calling lows, but at the same time, identifying where that low could come from and then how that could develop will give us an indication of how we can work in things into the rest of the fourth quarter. That's it for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.